Good afternoon, everyone, and welcome. My name is Mike Selfridge. I'm the head of wealth management at Zion's Wealth, and I want to thank you for joining us today for our quarterly market update. Today, we have several topics, including the current economy and markets, and how we at Zion's are positioning our client portfolios and navigating this interesting economic landscape. Today, our markets are certainly shaped by a number of factors, and our clients have many questions as it relates to unfolding economic data, elevated market valuations, interest rate expectations, inflation, corporate earnings, geopolitical events, just to name a few. And so I am very delighted to introduce our speaker to present our market update this quarter, Anthony Valeri. He is our Executive Vice President and Director of Investment Wealth Management at Zion's Wealth. Anthony is an industry veteran, and at Zion's Wealth, he is responsible for all aspects of our investment and management activities for high net worth families and businesses that we serve at Zion's Bank Corporation and our 7 affiliates serving the 11 Western United States. Anthony's responsibilities include portfolio construction, asset allocation, investment research, and our investment communications. I'm going to hand it over to Anthony. He'll speak for about 20 minutes, and then we'll go into Q&A. If you have a question, there is a Q&A button on your Zoom link. Please feel free to add a question. I will try my best to get to it after about 10 minutes, and we'll conclude this 30 minutes from now. So with that, I will turn it over to you, Anthony. Thank you.
All right. Thank you for joining us today, Mike, and congratulations on your new role. Today, I'll cover the economy and financial markets at the midway point of 2026, touch on some of the key themes impacting investors, and conclude with an outlook for the remainder of the year. So let's go ahead and get started, and we will start with the economy. And the real takeaway from the first half of 2026 is that the economy has been very resilient despite higher energy prices. Economic data has surprised to the positive more often than not in 2026. This is the U.S. Economic Surprise Index, and it measures the degree to which economic data either surpasses or falls short of expectations. And you can see the general trend higher in 2026, a little dip in late March and April as energy prices increased. We had the Iranian conflict, of course. But since then, the economy has proven more resilient, and that's been a key driver of financial markets so far in 2026. Now, if we think about the economy in terms of economic growth, that resilience has translated into very minimal changes in economic growth expectations. We can look at consensus forecasts for the remainder of the year. And as of March 1st, the forecast was for a 2.5% GDP growth rate. As of June, that's down a little bit, only 2.1%. So the economy holding in fine. Again, a lot of that due to the stimulus from the One Big Beautiful Bill Act. And as the second quarter progresses, the Atlanta Fed GDP now is actually tracking to a 2.5% growth rate, which is a little bit better than that consensus. So wouldn't be surprised to see that higher. And again, the economy doing better than expected. The impact from higher energy prices not as much as feared. What we like to do within Zion's Wealth is look at what are some of the factors that might create a recession or might change the tone in the economy. The National Bureau of Economic Research, NBER, has key data points that they follow for the health of the economy. One of those is the manufacturing sector and manufacturing trade and sales. And you'll see the increase here on the right moving higher. This looks more like an early expansion and reflects strength in the economy. Certainly not a data point that we would use to say a recession is around the corner. Another data point not shown here, the new orders component of the ISM Manufacturing Index, one of our favorite leading economic indicators, continues to point in the same direction, showing renewed growth as well. The Establishment Survey, another one of the NBER's data points that reflects the health of the economy, and the jobs market's actually improving over the last few months. For much of the past year, it was very much what we would characterize as a low hire, low fire environment. And we're starting to see some signs of life in the job market. The last 3 months, if you look at the right-hand side of this chart, payrolls growth has been very strong. It's actually the strongest 3-month pace of payroll growth since early 2024. You can see the 3-month average there. So some new signs of life in the labor market, which is very encouraging and again speaks well to the health of the economy. On a related note, we know that AI and job displacement is very much a theme in the market and a concern. If we look at youth employment, unemployment rather, we're not seeing much of an impact. In fact, age 20 to 24, unemployment has come down and contradicts those fears of AI impacting youth employment. Now, it's still early on the impact of for AI on the jobs market, but it's worth mentioning here that over the last 100+ years, new technology has generally led to new jobs and not had an adverse impact on the economy. There are many who think this time is different, but so far the data does not support any job displacement from AI. Something we will continue to monitor, of course, but again, no data as of yet that supports that notion. Let's turn to the consumer, and consumer spending remains very firm and another support for the economy. This is also an area for the NBER. Consumer continues to be a workhorse. On the left, we show retail sales from their trend growth line remain elevated. Retail sales for May were recently reported and were slightly stronger than expected. On the right, Johnson Redbook same-store sales approaching a near 10% growth rate on an annualized basis. A lot of that supported by tax refunds, which more than offset the impact of higher gasoline prices to the consumer earlier this year. So consumer hanging in there, doing just fine. However, a risk for investors is that income adjusted for inflation is actually turning negative. So this is the one cautionary point that among the NBER's data points for a recession. So something to watch in coming months. This can resolve itself one of two ways: either stronger income, which seems less likely, or a decline in inflation, which we think might be around the corner. So something to keep in mind as we move forward. In terms of inflation, the Consumer Price Index, the most commonly cited measure of inflation, has been moving higher, 4.2% overall as of the end of May. Here we break it down by component, and you can see that it's all energy, denoted by the red portion of the bars there. You're not seeing inflation trickle through to other areas, still relatively controlled, and there are a number of factors pushing down on inflation as well. And when you think about oil prices now back to almost the same level as prior to the start of the Iran conflict, we may be seeing peak inflation right now, and that could translate into lower inflation, lower CPI in the months ahead. So that outlook for inflation may have very well peaked with the May data. And again, it'll still be a watch to see if inflation leaks into those other sectors, but we see more of a slow decline going forward. Then finally, on the economy, and this will lead into our discussion of stocks, business investment has been very, very strong. For many of you are aware, the build out for AI has been a key driver of this, and thought it worth mentioning that when you look back over history and you look at capital goods ex aircraft to symbolize business investment, it tracks closely with corporate earnings. So when business investment is strong, you can see that these lines move together, meaning that earnings growth for the S&P 500 tends to move higher along with business investment. And so this has been a key support for the equity market. And a lot of this business investment, of course, driven by the hyperscalers, Google, Meta, Amazon, and Microsoft, as they continue to build out the AI infrastructure. You'll note again that these move in tandem. The last time we had an acceleration in business investment was 2018. And it was also the last time it was not a post-recession rebound, so sort of a mid-cycle increase. In that regard, very similar. No surprise that earnings growth in 2018 increased to 19%, which is not too far off of today's levels. And again, technology is the main beneficiary of that business investment expenditure, but there is trickle through to other areas of the equity market that have benefited, namely industrials, materials, real estate, and utilities. So there is a broader pass-through that is helping the equity market. from this business investment. One longer-term watch from business investment is the CapEx from this is going to end up increasing depreciation and amortization in years to come, which could negatively impact earnings. So some of the longer-term flip side of that business investment. But for equities, the shining star has been strong earnings. Here we show earnings estimates for 2026 and 2027. They've been steadily moving higher and continue to move higher even after the conflict of Iran started in March. That's a real good sign of resilience for corporate America. Earnings growth for the first quarter coming in at about 29%. That is really strong, even excluding Amazon and Google, which had one-time items to push that higher. We still had earnings growth of 16%, top-line revenue growth of 11%, really strong numbers. And for the full year, expecting 26% growth for the S&P 500. 2027 earnings have been increased higher as well, as you can see here, with annualized growth expected to be up 17.5%, up from 16% 3 months ago. So the earnings story, very, very bright. Over the long term, it's earnings that drive stock prices. It is tough to be negative on stocks when earnings growth is this strong, and corporate America continues to have strong profit margins. We can decompose equity market returns to find out what's really driving stock prices. And on the far right here, you'll see that we can break this down into earnings, valuations, dividends, with the red dot showing the total return. This is data through June 24th. And you'll see the two bars on the right show that in dark blue show that earnings are really the driver. And that is a healthy sign. It's not just a valuation run up. If you look at the far left of this chart, the late 90s dot-com bubble, it was valuations that were one of the dominant drivers of rising stock prices. So it's good to see earnings being the driver of stock market returns. What does that mean from a valuation standpoint? Well, it means that valuations really haven't changed much here today because earnings is doing a lot of the heavy lifting of returns. And here we show the trailing price to earnings ratio of the S&P 500. It hasn't changed much from the beginning of the year. So minimal valuation expansion year to date as earnings does the heavy lifting. The forward price to earnings ratio is 21. Both of these metrics are elevated relative history. Yes, it is an expensive stock market, but on a forward basis, 21 in our view is not overly exaggerated given the strength in earnings. So that type of earnings growth will command a higher than average valuation. How did that translate into return? Well, a good first half for investors, strong returns across the equity markets. S&P 500 in light blue there representing large cap. Lots of dispersion within U.S. large cap as mega cap tech dominated performance, and I'll talk more about that here in a moment. Emerging market equities have benefited from attractive valuations and stronger than expected earnings growth. Again, another earnings theme there for emerging market equities. Small cap stocks also benefited from better earnings and valuations. We are very modestly overweight small caps. Small caps typically do best coming out of a recession, so we expect more modest performance going forward. For emerging market equities, we still maintain an overweight, still expect strong earnings growth there to power that segment, and we still find valuations attractive there as well. Back to technology, and important to note that there was a historic 2-month rally in the technology sector for April and May, up over 40%. If you look at this chart, which goes back all the way to 1999, you can see that that is an extreme. And when you have that kind of extreme performance, there usually is some payback. That's the strongest performance since November of 2002, when the equity market was rebounding from an extended bear market. So this type of strength should give pause, and it also explains the rotation in the markets. Now, April and May were really dominated by mega cap tech. If you did not have a market weight there, and it's a very concentrated segment of the market, you likely lagged the broader indices. When we look at the changes, however, June has seen late May through June has seen a reversal. And here we compare the S&P 500 market cap versus the equal weight. A declining line means the equal weight index is outperforming the market cap weight and vice versa. The equal weight is really a way to measure the average stock. So the average stock is starting to perform better That means from an investor standpoint that diversified portfolios are doing better relative to the market cap S&P 500. So after a strong run, we're starting to see that reversal again. We remain biased towards having a diversified portfolio and try to avoid the risks that come from the big concentration in the markets. So we expect the S&P, the average S&P to do better going forward. And again, that's like how we'd like to be positioned on a go-forward basis. In terms of what does that mean for the market, the S&P 500 has not made a new high since June 2nd. That's not cause for concern. When you look under the surface, again, you'll see some healthy dynamics that we highlight here. The NYSE cumulative advanced decline line is continuing to increase. That means more stocks are moving higher. And on the right, the percentage of S&P 500 stocks above their 200-day moving average, it's a measure of momentum in the market, also moving higher. And that speaks to the broadening of the equity market as well. So both of these reflect the rotation in the market, which we think is a healthy sign of a bull market, not the end of a bull market. So we are optimistic going forward on equities and continue to expect modest single-digit returns going forward. We do expect stocks to outperform bonds. During the second quarter, there was an 9-week winning streak in the S&P 500. This is historically rare. Went back to the early 80s to see other similar occurrences. There were 9 of them. None of them really indicated that investors should get, only one was negative over the next 12 months. We look at the average performance here of those long win streaks, and over the next 6 months, returns were somewhat subdued at 3.6%. Over the next 12 months, the average return 11.1%, slightly above the historical average. So all of these took place within the context of a bull market, and on average, again, not a sign to get out of the market, but rather a sign of strength within the equity market. So we wouldn't take that win streak as a negative. And then to conclude on our allocation within equities, did mention emerging markets. They're still attractive on a valuation basis. And one of the ways we look at that is forward PEs relative to various segments of the market. Here we compare emerging market equities to developed international. And you can see that the valuation is below average relative to developed international on a forward PE basis. Therefore, we continue to find emerging market equities more attractive compared to developed international. So our bias on the international side is certainly on emerging market equities. Developed international should benefit from lower oil prices, but the earnings outlook still, they're not as strong as what we're seeing both in the US and in emerging market equities. All right, lastly on the equity market, SpaceX IPO got a lot of market attention. Probably worth highlighting how have IPOs done historically. And on the first day, IPOs have done very well. This is data from the University of Florida. Strong performance on the first day, up on average 16.6%. But over the next year and 3 years, IPOs have generally underperformed. And over that same time frame, the S&P 500 has exceeded 10%. So it's those IPOs have lagged the broader market. It's not something that we would chase. And I thought it worthy noting, given a lot of the media attention around the recent SpaceX IPO and also high-profile tech IPOs to come. I should note that the other risk from IPOs would be supply, but with OpenAI mentioning they may delay their IPO, that's less of a risk. But even still, year-to-date supply is elevated at just over 100 billion, still well below the 400 billion that we saw for 2021. And in terms of a market cap basis, the projected IPOs would be about 0.2%, maybe 0.3% of the value of the market, which is still very modest and, in our view, quite manageable. All right, turning to the bond market, and notable disconnect here between treasury yields and oil prices. We look at the West Texas Intermediate price of crude, which is back down to right around 70 as of today. Note that the 10-year treasury yield hasn't followed it lower. These two almost moved in lockstep since March 1st all the way through mid-May, but there's been a disconnect since then. And it's always worth noting as an investor what's changed and what hasn't. Well, some of the themes impacting the bond market include central banks rising rates globally. Global bond yields are rising in response. Inflation has been a little more stubborn, obviously, right? increasing. And then some fiscal concerns are coming into play as well. So all of those factors are causing bond yields to remain elevated as bond investors build in more of a risk premium. We think that's reasonable. From an investor perspective, higher yields mean you can clip coupon over time. So although there's been some modest price pressure for fixed income, we still think they act as a good diversifier in investment portfolios. And to reflect the change in rate hikes, this also has been pressuring bond yields here in the US. This is the futures implied Fed funds rate at the end of 2026, and the futures market pricing in one rate hike by the end of the year. Again, if yields stay elevated, we think it's good for investors to get that extra yield. Don't see the Fed hiking rates, given that inflation is likely to come down and potentially risk putting the economy on bad footing. So one rate hike priced in, we think that leads to some opportunities in fixed income. One where we see more opportunity is in the municipal market. Here we show the taxable equivalent yield of A-rated munis. U.S. investment grade corporates are also an average of A rating. So if you're in the top tax bracket, there is a compelling yield advantage with municipal bonds. They've actually outperformed year to date, and this gap was wider in the first quarter. It's come in a little bit, but we still find municipals attractive. AAA municipals still offer, while they don't beat corporates on the short end, single A rated corporates, there's still a compelling advantage in the intermediate space. So we maintain intermediate exposure across our bond allocation and find munis attractive. I did not, in terms of high yield bonds, which we don't show here, not getting compensated there. If you're going to take risk, do so in the equity market, not high yield bonds. All right, those conclude my remark. Hope you found that useful. Mike, I will turn it back over to you.
Great, Anthony. I have, if you can hear me okay, I have a couple of questions that have come in. So I'm going to tie a few threads together, and thank you for the presentation. And I'm going to ask you to put on your Zion's Wealth portfolio manager hat. We've been talking about elevated valuations in the S&P 500 now for, it feels like a number of quarters, if not a few years. And I think we're about to close on probably the best quarter for the S&P 500 in 6 years. I liked your slide, I think it was slide 12, that showed this feels very supported by earnings as opposed to PE multiples in, I think, going back to the 2000, 2008, and even post-2020. So the fundamentals look good, but the question is really centered around the valuations today. In your view, is there a correction on the horizon over the next 12 months? And even if there is, how would you change your investment philosophy as it relates to portfolio management?
Yeah, we get that question frequently. We came close to the unofficial barometer of correction is down 10%, came very close to that in the first quarter. That happens about every 12 to 15 months. And to answer your question, Mike, no, we would not change your investment approach based on that. That is a feature of stock markets. Pullbacks, which are about 5% correction declines, those happen on average twice a year. So it's a feature of the markets. Would we have another one here over the remainder of the year? That's anyone's guess. But if you do, just stay invested and focused on your longer term goals.
That's good. Question on tariffs, and I'm going to step back a little and talk about two risks we might see here. One would be inflation, as you identified, which would lead into bond yields. And I appreciate your comments on the Fed, potential Fed hikes. It feels like just a few quarters ago, we were talking about Fed decreasing rates. Now we're talking about increasing rates, but then a little bit of downward pressure given the oil prices on inflation. So thoughts on maybe the forecast on inflation. Did tariffs have much of an impact on that? And with the new chair Warsh in the seat, how might that affect the Fed's view on rates going forward?
Yeah, Kevin Warsh had a very short meeting. He's looking to keep communications curtailed. That could lead to bonds building in more of a risk premium. But his messaging on getting inflation under control and being blunt about we will restore price stability, that kind of indicated the Fed might lean toward rate hikes. So that's what pushed up yields here in June. There's been some walk back of that language. So yields elevated really for stocks. When the 10-year goes above 4.5, that becomes more of a watch. I mean, even up to 5% may or may not be a risk. But once you get above that 4.5 threshold, historically, that's been some pressure or headwinds for the stock market. We're not there 10 years below that, but that is a concern should yields remain elevated.
Anthony, thank you. Another question on the labor markets. It looked like they remain strong. I liked your comments about AI, and we're not seeing the displacement yet, at least from the productivity gains in AI. But generally, your views on the labor market going forward as it relates to the U.S. economy in particular.
Yeah, we still see a stable labor market. Our early watch would be weekly jobless claims. That's one of our favorite leading indicators. They remain near historical lows. You're not seeing any weakness there. If it were to happen, you'd see it there first. The other would be consumer spending. Is it going to be impacted from higher inflation? And so far, consumers have dipped into savings, into wealth. They have a big cushion there, so they can keep doing that. But should that show signs of slowing, that'd be the other watch. But first and foremost, it's going to come down to jobs on the health of the economy. And so far, with weekly claims still near a historical low, not showing a cause for concern.
How about the indices, the major indices? They've been largely influenced by tech valuations. And would this be a good time for investors to diversify their portfolios based on maybe some of the outsized returns from some of those large mega tech caps?
We would say yes, Mike. That concentrated approach has worked for just over 3 years now. It didn't in 2022, which for many might be ancient history, but it's a reminder of what could happen if you're not diversified. Diversified portfolios worked a lot better. Then the Nasdaq at one point was down 35% in 2022, certainly underperformed. We would continue to be diversified to kind of have that concentration. Yes, if you're an aggressive investor and really want to try to leverage the earnings growth and technology, that's a way to do it. But with that comes a lot more risk on the downside. And maybe, speaking of the Zions Wealth hat, taking a look back at your financial goals. Do you need that risk? Do you need that level of return to achieve your financial goals? So probably a question to review with your own portfolio, with your financial advisor to assess that. But we would remain more diversified, Mike, on a go-forward basis.
Anthony, Valeri, thank you so much for the market update. Very, very well said. And we appreciate all that you do. And I especially want to thank each of you for your continued relationship with Zions and Zions Wealth. If you have any follow-up questions as it relates to this presentation, please reach out to your private banker or your wealth advisor. And with that, we'll conclude the market update. Thank you.